So we've got a range of forecasts out there when it comes to the country's economic growth forecast for this year. The Planning Ministry forecasting 4.2%, putting it at odds with Finance Minister Uhuru Kenyatta, who's predicted 6.1%. And then the World Bank now trimming back its forecast from 5.3% to 4.8%. So run us through the basis for your revised forecast.
Yes, Alicia. Basically, the essence of that slight downgrade by 0.5 percentage point relates to the global shock that Kenya is now affected by, and your previous story just referred to some of this on today's reflection. So basically the higher food and fuel prices especially do put a dent in the Kenya's recovery, which has been strong until now, and 4.8% for this year would still be a strong start into the new decade.
Let's run into your inflation expectations then, because we've seen inflation ramping higher this year. It's moved into double digits and at this stage posing significant threat.
Yes, absolutely. And that's linked also to the downgrade in the growth forecast. Basically, the logic is as follows. Kenya is one of the countries that is very much affected by terms of trade shocks with high oil prices. It's a net commodity importer. So a high oil price, around 100 barrels a dollar, does put pressure on the exchange rate, but also does put pressure on inflation, especially through increased food prices. So those elements together make it important for the central bank to put some brakes on lending and on the CPK rate. And they again yesterday increased, the day before yesterday, increased their benchmark interest rates. And so those are, the parameters again that make this year a bit more challenging, make a slight storm, but not yet a hurricane.
Of course, we've seen that weaker shilling exacerbating the problem to an extent, and we've seen that weakness filter through on account of the kind of intervention we've seen by the Central Bank of Kenya into the currency market, accumulating forex in order to shore up its reserves. What are you making of that kind of activity we're seeing, more specifically the timing of it?
Basically, there's a short and a long-term aspect. In the long term, a lower exchange rate that helps accelerate exports is maybe what is healthy for Kenya. But in order to accelerate exports, there's many other factors that come into play. Now, in the short term, the issue was indeed that the IMF suggested to have an increase in total reserves, and the government acted at this stage, could have done maybe a little bit earlier at better periods. But the essence, this is not a big challenge or a panic situation for the country. The exchange rate declined from 80 shillings to 85, around that range. This is not a dramatic movement.
What about the kind of monetary policy intervention we're seeing from that end as well? Because earlier this week, we saw all focus on the central bank's interest rate decision, the market largely anticipating a 50 basis point hike, and we saw only 25 basis points come through. We've had the IMF already being quite critical, saying that the bank is possibly behind the curve in this regard.
Yeah, but you have to emphasize also that they already increased interest rates in March. And then the bigger dilemma is that 70–80% of the inflation is linked to food and fuel prices and transport. And so those are areas where central bank interest rate has very little influence on. It's partly supply shock, it's partly external environment. So it seems the CBK has been more on the middle ground. Part of their challenge is they don't only have an inflation mandate like the European Central Bank, they also have a dual mandate to promote growth, like the American Central Bank. And as you do in your own coverage, that you see that discrepancy between Europe and the US, and you see that a little bit playing out in Kenya as well.
When it comes to initiatives being undertaken to promote growth, we've heard this week as well that Kenya's power tariffs are expected to rise by 20% over the next 3 years as consumers pay back, the cost of new investments that have been made in infrastructure. And that, it seems, is amongst the positives to consider when it comes to the economic growth scenario over on that end, improved infrastructure, including investment in telecoms.
Absolutely, and you see it already in numbers now. Part of the surprisingly strong performance of last year is partly connected with the infrastructure spending and infrastructure investments. Now, if you drive through Nairobi or Mombasa, you still see the big deficiencies, both on the transport side and on the energy side. And so it's basically a long path of continuous investment to really catch up to the demand that Kenya would have. But there has been continuity and there has been an emphasis, and I also understand from the next year's budget, this would be still a big emphasis for Kenya's public expenditures.
Of course, just reading through your report today, highlight being made on the fact that we've seen an acceleration in South-South integration as well, and that providing nice impetus. Run us through how exactly we're seeing the effects of that filter through when it comes to economic growth in Kenya.
Yeah, that's a very interesting observation you're making, and you see basically what's happening in the world, the shift from west to east, from north to south, playing out in Kenya as well. So in the last decade, in the 90s, used tea, Kenya's main export commodity, biggest foreign exchange earning. Tea was mainly exported to the UK. Now the UK dropped to third place. It's Pakistan and Egypt, which are Kenya's main markets for tea. You see in some new manufacturing products, and including in chemicals, some very sharp acceleration of Kenya's exports from a low base, but these exports are mainly to Africa and partially to Asia. So that's where Kenya has been benefiting thus far. Some regional integration from the African growth momentum, but has not yet been integrating in global supply chains. And that's why it comes back to Kenya's coastal location and the performance of the port of Mombasa.
Well, you've touched on regional integration. What are you making of the strides being made in that regard? Because, of course, we've seen that East African Common Market Protocol come into effect. Do you think enough progress is being made there, and are we starting to reap the benefits?
Yeah, I think it's slowly but surely. In trade, you see the numbers clearly. Also, Uganda has taken now over as Kenya's prime export destination, prime trading partner from Britain. But while tariff barriers have been declining, non-tariff barriers are still a major headache. And if you would just go through, drive through the border post, Kenya, Tanzania, Kenya, Uganda, you could confirm that this is not yet an efficient running of the East African community. Having said that, some of the companies, including Kenyan companies who are very much profiled in the East African region, have already positioned themselves in some of those countries to anticipate that further integration. And the high growth in Tanzania, Uganda, Ethiopia are all reinforcing each other and helping Kenya in that respect as well.